Welcome to the Deep Dive, your shortcut to being well-informed. We take the latest, most complex information, earnings calls, research papers, you name it, and really distill it down for you.
We try to find the core nuggets you need to stay ahead.
Exactly. And today we're plunging into the recent Q2 2025 earnings call from Civista Bank shares, tickers CIVB.
And this wasn't just, your standard quarterly update.
No, definitely not. It was packed with strategy, a significant acquisition, a big capital raise, alongside all the usual financial results.
Right. And you might have even seen that positive pre-market move in the stock after the release.
Yeah, suggests the market's really dialed into what Civista's planning strategically.
It's fascinating, actually. It feels like they're actively engineering their future here. This isn't just about the numbers themselves.
It's the blueprint underneath.
Precisely. Understanding the structure they're building for the next few years.
Okay, well, let's start with laying out those headline numbers for Q2 2025. They kind of set the stage.
Good idea.
So net income for the quarter hit a very strong $11 million.
And just for context, that's a pretty substantial 56% jump year over year.
Huge jump. And on a per-share basis, the GAAP EPS landed at $0.71.
Which actually nudged just past the consensus estimates. I think they were looking for 71 cents.
That's right. There's on 70 cents, so a slight beat there.
And looking at the core banking stuff, their net interest margin, the M.
Always key for banks.
Absolutely. It expanded nicely, up to 3.64%.
Okay, and how much was that up year over year?
13 basis points from last year. A wider margin like that, it's generally a very healthy sign for profitability.
Right, it's that core spread. What about efficiency?
Also saw significant improvement there. The efficiency ratio dropped quite a bit, down to 64.5%.
Wow, from 72.6% last year.
Yeah, exactly. That's a really solid indicator they're managing costs better.
And return on equity, ROE, another important one.
Also saw a healthy rise, climbed up to 11.02%.
From?
7.77% year over year. So good improvement across the board on those key metrics.
Okay, digging maybe a layer deeper into revenue. Net interest income was $34.8 million.
Correct. And total revenue net of interest expense came in at $41.4 million.
Now, there was one area that declined though, right? Non-interest income.
Yeah, that's worth flagging. It did see a decline, roughly 36.5% compared to last year.
And they gave a reason for that.
They did. Management pointed mostly to lower fees from their leasing operations and also a dip in residential fee revenue.
Okay. So mostly fee-based lines.
But it's also really important to add some context to these Q2 numbers.
Oh, what's that?
Well, they had a bit of a, let's call it a tailwind, a one-time non-recurring positive adjustment.
Ah, okay. How much?
It was $757,000. Related to a system conversion in their leasing division.
So if you strip that out.
Exactly. If you looked at sort of underlying operational performance, net income would have been closer to $10.3 million.
Or 0.66 per share.
Right. So, the JAF numbers were still impressive, but definitely boosted by that one-off item.
Okay, that context is crucial. Thanks. But now let's shift gears from the immediate numbers to the bigger picture stuff, the strategic announcements.
Yeah, this is where it gets really interesting.
Top of the list has to be that major expansion move, the definitive agreement to acquire Farmers Savings Bank, based in Spencer, Ohio.
This looks like a really savvy move. It's expected to bring in somewhere between $183 million and $233 million in deposits.
And critically low-cost deposits.
Exactly. That's the lifeblood for a bank, right?
Yep.
Stable, inexpensive funding. It directly helps that net interest margin we talked about.
But it wasn't just the acquisition announcement.
No, and this is key. It didn't happen in isolation. Civista simultaneously closed a big follow-on equity offering, $80.5 million.
Okay, the capital raise, how much did they net from that?
After costs, they raised $76.274 million. And that involved issuing nearly 3.8 million additional shares.
So bringing in deposits and fresh capital at the same time, smart pairing.
Very smart. And management was clear about the immediate plan for that cash. Paying down overnight borrowings saves them on interest expense right out of the gate.
Makes sense. But the longer-term play is obviously deploying that into loans.
Absolutely. Fueling future growth.
Yeah.
And the impact on their balance sheet is pretty significant, too.
Right. Talk about the pro forma ratios.
Okay, so pro forma, the tangible common equity ratio, or TCE, that's expected to jump from 6.70% up to about 8.6%.
That's a big jump.
Yep.
And the Tier 1 leverage ratio.
Also projected to rise substantially, from 8.80% to around 10.6%.
And what does that mean in practical terms?
Well, it effectively positions Civista as well capitalized according to regulatory standards, which is a very good place to be.
So a much stronger financial cushion.
Exactly. That TCE ratio is a critical measure of their ability to absorb potential losses. And Tier 1 leverage is another core regulatory metric for resilience.
And management saw this pairing, the acquisition and the raise, as a way to do both, boost capital and offset dilution.
That's precisely how they framed it. A
Oh.
great opportunity, they said. Improve capital ratios, but also use the acquisition's earnings to counter the impact of the new shares. It's quite a calculated approach.
And they expect the farmers deal to close when?
Q4. Q4 2025 is the target, yes.
Okay. Now that brings us to another really interesting piece of their forward-looking strategy, digital transformation. The Mantle platform.
Right. They officially launched this new digital deposit account opening platform just in July.
Feels like a pretty significant strategic leap, moving beyond their traditional footprint.
Oh, absolutely. Mantle is specifically designed to attract new online customers, people who might never walk into a branch.
And the marketing is focused there too, new customers.
Yep, targeting that new demographic specifically.
Yeah.
And the core objective, again, comes back to deposits.
Growing those low-cost core deposits.
Exactly, which, as we keep saying, are vital for the NEOM and for enhancing their overall lending capacity.
And they expect this to ramp up soon.
Yeah, they're looking for it to really hit its stride in Q3 and Q4 this year. So we'll be watching that impact closely.
Okay, so we've got strategic expansion through acquisition and digital growth through Mantle. How does this connect back to their sort of day-to-day operational discipline and credit quality?
Well, that improved efficiency ratio we mentioned earlier really speaks to strong cost management.
Right, down to 64.5%.
And non-interest expense actually declined year over year,
How'd they manage that?
driven by a couple things. Lower equipment expenses, but also a reduction of, I think it was 11 full-time employees.
Ah, okay. Stemming from some branch closures and call center shutdowns.
Exactly. It shows a real disciplined approach to streamlining how they operate.
And on the lending side, were they still growing loans?
They were. The loan and lease portfolio grew at a pretty healthy 6.8% annualized rate organically during Q2.
Any particular areas?
Residential loans saw a particularly notable increase, up about $42 million.
And crucially, how did credit quality hold up with that growth?
That's the impressive part. Despite the growth, they maintained strong credit quality. Non-performing assets, or NPAs.
Those are the problem loans, basically.
Right, loans where payments are way overdue.
Yeah.
Those were reduced to approximately 0.55% of total assets. Lower is always better there.
Okay. And their allowance for potential losses.
The allowance for credit losses to total loans held steady at 1.28%, consistent with prior periods. That's their buffer.
And any movement in criticized credits, those loans they're watching closely?
Even better news there. Criticized credits actually declined by $2 million.
Oh, wow. Why was that?
Largely due to paying off a single $7.2 million substandard and non-performing loan. So actively resolving problem credits.
Good to see. Did they provision more for losses this quarter?
They did make a $1.2 million provision, but that was primarily driven by the loan growth itself, which is standard practice.
Right. Got to set aside more as you lend more. Any specific charge-offs?
There was one notable one, $549,000, associated with a non-operating hotel loan that was already in workout, so part of managing the portfolio.
Understood. What about their securities portfolio? Any unrealized losses there, given rates?
Yeah, that's always relevant now. The portfolio was about $645 million. And as of June 30th, it had about $63.1 million in unrealized losses.
Which reflects the rate environment, but doesn't hit earnings unless they sell.
Correct. If they hold to maturity, it doesn't impact earnings directly. The key takeaway, though, across all this is that their core credit quality looks robust.
Okay, great summary. So we've dissected the Q2 results, the big strategic moves. Let's maybe zoom out now. Investor context. What's management signaling for the future, starting with NEM and loan growth?
Okay, yeah. On NEM, they actually anticipate a slight dip in Q3.
Oh, really?
Yeah.
After it just expanded?
Yeah, they're projecting it to land somewhere in the low to mid 3.50% range. Think 3.52% to 3.53%.
Why the temporary dip?
It seems pretty strategic, actually. Two main reasons. Shifting their CD focus towards shorter terms, maybe playing defense on rates,
Okay.
and also the immediate impact of using that new capital to pay down higher cost borrowings before it's fully redeployed into loans.
Ah, so it takes time for the new capital to start earning at loan rates.
Exactly. But they're quite confident NI will expand again in Q4.
Once Farmers is integrated and the capital's working.
Precisely. So a temporary tactical dip, then back up.
Got it. Now, what about loan growth? This sounds like where the big story might be.
This is definitely compelling. They see loan growth remaining in the mid-single digits for the rest of this year, 2025.
Okay, steady.
But then, and this is the key part, they expect it to accelerate into the high single digits in 2026.
High single digits. That's a significant ramp up. What's driving that?
It's directly tied to leveraging those excess deposits coming in from farmers, plus a robust loan pipeline they say they're building now.
So using the cheap funding from the acquisition to really drive lending next year.
That seems to be the explicit plan, setting up for a significant acceleration in their core business.
Now, that kind of growth ambition, especially in deposits, it raises questions about the competitive landscape. Did they address that?
They did, quite openly actually, acknowledged it's a highly competitive environment for both deposits and lending right now.
Seeing pressure from bigger players.
Specifically mentioned larger regional banks becoming more aggressive.
Yeah. So how are they planning to counter that, besides farmers and Mantle?
Well, those two are the cornerstones, acquiring low-cost core deposits that way. But they're doing other things too.
Like what?
Monthly marketing blitzes targeting their existing loan customers who have low or no deposit balances with them.
Trying to deepen those relationships. Smart, yeah. Also considering hiring more treasury management officers, that's for attracting commercial deposits. And even exploring new branch locations.
So not giving up on physical presence either. An all-fronts approach.
Seems like it. And you can see the urgency when you look at their loan-to-deposit ratio.
Where did that stand?
It was 98.6% at the end of Q2, which they explicitly said is higher than they'd like.
What's their target range? They want to get that down to 90-95%. So it really underlines why getting these deposit initiatives right, including farmers, is so critical.
Okay, that makes sense. And how does this all feed into their capital allocation strategy?
Well, the overarching goal they stated is maintaining enough capital for strong organic growth and potentially more acquisitions down the road.
Did they buy back any stock in Q2?
No share repurchases in Q2. But management did reiterate they think the stock is good value.
And the dividend?
Kept it consistent. Declared 17 cents per share, same as the prior quarter.
What kind of yield is that?
Works out to about a 3.2% yield, and the payout ratio is just under 24%.
So, pretty reasonable payout, balancing shareholder returns with retaining capital for that growth plan.
Exactly. Future capital allocation, they said, will continue that balancing act. Dividends, maybe some buybacks, but prioritizing capital build for growth.
Okay. Any broader comments on the economy or industry? They're based in Ohio, right?
Primarily Ohio, yeah. They highlighted Ohio as being pretty business-friendly right now, seeing job additions, significant company investments happening in their footprint.
Which helps drive loan demand.
Absolutely.
Yeah.
Contributing to what they described as strong loan demand across their markets.
But, as you said, tempered by that intensifying competition, especially from the bigger regionals.
Right, that's the push and pull. One other interesting point they touched on was tariff exposure.
Oh, what did they say?
Noted that while manufacturers in their area seem optimistic about, potential domestic shifts in supply chains.
Onshoring, reshoring.
Yeah. But that capital expenditure, the actual spending on new equipment, factories, expansions, that hasn't really accelerated yet.
So, optimism, but maybe some caution before writing big checks, waiting for more clarity.
Seems like it. A bit of a wait and see from businesses on major investments, perhaps.
All right. Fascinating quarter for them. Now, this is the segment where we put on our speculative thinking caps. And let me stress, this is not financial advice. Always do your own homework.
Absolutely. Purely informational brainstorming here.
But given everything Civista laid out, the strategic positioning, that bullish outlook, especially on loan growth, accelerating into 26.
Driven by farmers in Mantle, really hitting their stride.
Right. Here's a thought for consideration. What if the market is underestimating the combined sort of synergistic impact of all these moves?
It's possible. Integrating an acquisition, deploying capital, launching a new digital platform. Lots of moving parts.
So consider this. A speculative, long-dated, out-of-the-money call option strategy on CIVB.
Okay, long-dated, like targeting late 2026 or even early 2027 expirations.
Exactly. The thinking or the potential play here is essentially a leveraged bet.
A bet that
What?
that the market hasn't fully priced in this transformation story?
Precisely, that the combination of farmers' low-cost deposits, the efficient capital deployment, and Mantle successfully grabbing new digital customers
could lead to significantly higher loan and deposit growth than maybe current analyst models expect.
Right. And if that multi-year storyline truly plays out, maybe even exceeds their own high single-digit loan growth target for 2026.
It could potentially lead to a substantial re-rating of the stock price, higher earnings, better metrics.
Exactly. It's definitely high risk, make no mistake. You're betting on future execution.
And options are inherently risky, especially out-of-the-money ones. This is purely speculative.
Cannot stress that enough. For informational purposes only, do your own research.
Agreed. Okay, so maybe let's wrap up the key takeaways from this Civista deep dive.
Okay. So Q2 showed strong profits, good operational discipline, even accounting for that one-time item.
But the real headline is the strategic maneuvering. The farmer's acquisition, the capital raise.
Yeah.
These are big forward-looking moves.
And the launch of Mantle. That signals a clear, pretty aggressive path towards future growth, trying to compete effectively in a tough regional banking space.
Yeah, it's about getting efficient, getting digitally savvy, and securing that low-cost funding base.
And the market's positive reaction, initially at least, suggests some confidence that Civista can pull this off.
Right. Confidence in their ability to integrate farmers, deploy the capital smartly, generate solid earnings, and ultimately build that long-term value.
It's a compelling narrative they're building. As always, this discussion was just for informational purposes, definitely not financial advice.
Thanks for tuning in to the deep dive.
Yeah, thank you. And maybe something for you to think about. How disruptive could that Mantle platform actually be for them? If it really takes off in attracting purely digital customers, how might that reshape their deposit base, their costs, and maybe even their valuation over the next few years? Something to chew on. We'll see you next time.